Hello, good evening, everyone. I am Miss Aisha from WebTutor. I am an online tutor at WebTutor. So today I'll be teaching Edexcel A2 Accounting, and it will be Chapter 8, which is Project Appraisal. So let me share my screen first, and I'll explain. Okay, so this chapter is easy. Okay, it's a bit difficult, but if you think that it's easy, it's definitely going to be easy for you all. So I will explain only the parts that is important for your exams. Okay, not the whole book, not the whole lesson. Okay, so whenever I teach my students, I will teach only the parts that is important for them. Important for them to remember for the exams. Okay, so let's get started. Okay, so decisions are made regarding when and how to spend money on capital projects. Okay, so in other words, project appraisal is the evaluation of investment projects. Okay, so there are two methods of calculation to calculate project appraisal. So the first method is non-discounted method. The second method is discounted method. And it's important for you all to know what comes under non-discounted method and discounted methods. Because in the exam, they will, so in the theory question, 6 marks or 12 marks theory question, they will ask, evaluate the non-discounted methods of project appraisal, something like that. So they won't directly tell payback period, average rate of return. So in that case, you all need to know what is non-discounted method. Okay, so non-discounted methods are payback period and ARR, which is average rate of return. And discounted methods are NPV, net present value, and IRR, internal rate of return. Okay. So now let's study payback period method. So if you all have any doubts, put them in the chat box. I will explain it to you all at the last. Okay, and if you all can't understand anything, please let me know so that I will explain you all again. Okay, so payback period. So payback period, payback period is the length of time a capital project takes to return the initial cost of investment. Okay, so let's study how to calculate payback period method. Okay, so it is simple. So now look at this, look at my screen. So now they are giving, okay, so say, uh, a company has year 1, 2, 3, 4. Okay, so they have an annual flow for year 1, 2, 3, and 4. Okay, so the cumulative cash flow of this. Okay, they will give you all only annual cash flow. We have to find cumulative cash flow. So first we'll find this. Okay, so in the textbook, a textbook method is a payback period. So here, instead of initial cost, put 0. Okay, so this will be year column, and put 0, year 1, 2, 3, 4. That's all. And then under annual cash flow, under year 0, you all have to put the cost of the project. Okay, so look at this. They are saying the cost of the project is 730,000. Okay, for project 1. So that's why they have put 730,000 here. And then under cumulative cash flow, so year 1, under, okay, give me a minute. Just give me a minute, I'll be back. Sorry, I made a small mistake. Okay. So textbook method, I told I won't teach the textbook method. So in my method, under year 0, net cash flow is 0. Okay. That's a small mistake. So net cash flow is 0. Net cash flow, you all can call them as annual cash flow. Cumulative cash flow. Under cumulative cash flow, you all have to put this. So I'll properly do it here. Year 0, 1, 2, 3, 4. And under net cash flow. So net cash flow will also be 0. And under cumulative cash flow, you all have to write the cost of the project, which is 730,000. Now year 1. Okay, so all the net cash flow. So in the question they will give. So year 1 it's 200,000. Year 2 it's 210,000. And year 3 it's 220,000. Year 4 it's 240,000. So now in the exam, they will give only the question. So it's very easy when you all do payback period in the table format. Okay, so just draw tables like this and just write like this, and then you all can do. So now cumulative cash flow for year 1. How will you all do that? So you all have to put this 730,000 in brackets because it's a minus value because it's the cost of the project. Okay, so for year 1, minus 730,000 plus 200,000. So minus 730 plus 200,000 will give minus 530,000. Okay, so that also you have to put in brackets. Now for year 2, minus 530,000 plus 210,000. Okay, so that will give you all minus 320,000. If you can't remember what I am teaching you all can take a notebook and write it down. Okay, so for year 3 cumulative cash flow is minus 320,000 plus 220,000. Okay, so that will give you minus 100,000. Now year 4 minus 100,000 plus 240,000. It will give a positive value, which is 140,000. So until you all get a positive value, you all have to do this cumulative cash flow. Okay. So now you have got a positive value. So you have to stop with this. Okay. Now from this only you have to calculate the payback period. So after doing this, the payback period is 3 years. Plus, we all have to find in months. So how 3 years? Because until this minus value only and 3. So you all can write therefore pay server duty to find it in months. Because in year 4, they have a positive balance. Okay, so that which means year 4 they are paying it fully. They are recovering the cost fully. But you all have to find it in months. Because year 4 we don't know when did they recover that amount. So you have to find it in months. So to find it in months, you have to follow this equation. Look at my screen. Months equals negative balance required divided by net cash flow in payback year into 12. So negative balance required. Look at this. 100,000. So year 3 only negative balance required. So which is 100,000 divided by net cash flow in payback year. That means now year 3 the cumulative cash flow is minus 100,000, right? So the next year's cash flow, annual cash flow. So after this, the next year's cash flow is 240,000. So what you need to do is 100,000 divided by 240,000 into 12, which will give 5 months. Okay, the working is here. So I didn't do the working. So years and 5 months. So this is the answer for this question. Did you understand, Fairoz Seema? Did you understand? Can you tell me? Can you unmute yourself and tell me? Did you understand this? Okay. Do you want me to explain this again? Okay, I can explain it to you again if it's confusing. Do you want me to explain it again? Okay. So now let's start the next method. Sorry, before that, we'll study the advantages and disadvantages. After that, let's go to the next method. So advantages and disadvantages, you have to just remember it lightly, not deeply. Okay, so just you all can read these points and remember, okay, not to study it deeply. So you all have to know that the advantages of payback method is that it is a simple calculation and it is easy to understand. So it is highly favored by managers and non-accountants too. Okay, and it considers the cash inflows and outflows for the year. Okay, so it reflects liquidity and it recognizes the cash received earlier in the project is probably preferable to cash received later, and it indicates the project that is at risk for the shortest amount of time, because payback period will help a company to understand uh, like the amount of time taken to cover their original cost of investment. So if they do that, it will be very easy for them. Okay, so it identifies the risk. Okay, and disadvantages of the payback method: it does not measure total profitability over the over the life of the investment. Okay, so total profitability it does not measure that, but ARR will measure total profitability, but payback does not measure. So that's a disadvantage. Okay. Uh, so it does not measure total profitability, but it will tell how long it will take to recover the original cost of investment. Okay. And the second point is does not consider the time value of money. Okay. So I will explain what is time value of money when I am teaching net present value and IRR. But for now, you have to know payback period does not consider the time value of money. And third one does not recognize the net cash inflows after the payback period. Okay, it does not consider the net cash inflows after the payback period. And life of non-current assets are also not considered in the calculation. Now let's study average rate of return. So average rate of return, or we can call it as accounting rate of return. So they can give both the words. Okay. So that is the percentage return expected from a capital investment project compared to the initial investment. Okay. So how many percentage we will receive compared to a capital investment project. Okay. That is ARR. So the equation, you have to study only the equation in this method. Okay, so if you study the equation, it will be easy. I'll do a one past paper question in my next accounting free session. That will be next week. Today, I will teach only the theory part. Okay. So ARR percentage, you can calculate average annual profit divided by average investment into 100. And then average annual profit equals total profit divided by number of years. Okay. If not average investment, you can calculate closing value of investment divided by 2. Okay. So this will be easy when I teach you with the past paper question. Okay. For now, you have to remember all the equations. And then finally, to calculate ARR, you have to take the average annual profit and you have to divide it by initial investment into 100. Okay. So there are some notes to remember when you're studying project appraisal chapter. So they can say initial investment, or they can give you the word as cost of the investment, or they can even tell cost of the project. They can tell all these three words. They'll give the one word. So you have to know if it's initial investment is the cost of the project, or if it's cost of that. And also in payback period method, you must not take depreciation. Okay. So remember these points. I will tell some points for you to remember. Okay. So I will tell at last, you have to copy it down. Okay. Now let's study. Okay. And also in ARR, depreciation must be taken. Okay. We have to take depreciation when calculating ARR. And saleable value. We should not add saleable value in ARR. So in a question, they will give this good had a saleable value of this much. For example, if they say like that, you must not add saleable value under when you are doing ARR calculation. Okay. And also we have to take depreciation, plus we have to take interest cost also. Under ARR, we have to take interest cost and depreciation. Note that down. Okay. And also remember, under payback period, we must not take depreciation. Okay. So I'll move on to the next part. So we'll study the advantages and disadvantages of ARR method. Advantages, simple calculation and it is easy to understand. Okay, so it is highly favored by managers and non-accountants. And ARR focus on profits. Okay, often a company's primary objective, and accounts for all revenues and costs of a capital project. Okay, it takes into account all the revenue, all the cost. Okay, all of that. And disadvantages, it does not consider the time value of money. Okay, and it does not consider the timing of the cash flows. So the timing of the cash flow is important if a company has liquidity problems. So now ARR does not consider that. So it's a disadvantage. And it does not show how long the project takes to recover the initial outlay. That means initial cost. Okay, cost of the project. And it does not consider the duration of the project also. Moreover, profit figures are only estimates. So estimates mean predictions, so which is a disadvantage because predictions are not 100% accurate. Okay. So before I start NPV, can you tell me whether you understood ARR? Seema, can you tell me whether you understood ARR? Okay, so you told me you can understand the ARR calculation. Okay, fine. I will explain that to you again. But then this is just a formula. Okay, if you do, if I have a past paper question, then I can completely explain you properly. I can properly explain you fully. I can explain you the whole thing. But since there's no theory today, okay, the full theory of this chapter. First, you have average annual profit. Okay, so in the question, they will give total profit for year one. Okay, so they'll give total profit for year one, profit for year two, three, four, five. So let's say year 1 to 5, they gave profit. So you have to add year 1 to year 5, you have to add all the profit. So under average annual profit, you have to add all the profit and put it here. Total profit divided by number of years. Number of years means for how many years they have given the profit. So I told until year 5 they have given the profit, right? So total profit divided by 5. Okay. After that, that answer you have to put it here. Average annual profit. Okay. Look at this average rate of return. Hold on. Okay. So look at this. This is the main equation. So first you have to calculate average annual profit. So you got that answer, right? So you have to put it here. And then divided by initial investment. Or we can say it as average investment. So average investment, they have given an equation, uh, equation. So you have to memorize that equation. So how to calculate average investment? Average investment equals opening value of the investment plus closing value of the investment. That this one they will give in the question. Okay, so you have to just take that and you have to divide that answer by 2. So this one's answer, you have to write it here under this, under initial investment. After that, now you know the numerator and you know the denominator. You have to take those answers and multiply by 100. Then you will get a percentage like 6.7%, 5% like that. Did you understand now? Okay, you're welcome. Okay, so I will explain the next part. Don't worry, we can do past paper questions. We can do lots of questions. So you can, yeah, so you will be 100% familiar with this chapter if you do lots of past paper questions. So give me a minute. Okay, just a minute. Okay, so before continuing this, okay, so you asked me what time the session will finish. I'll finish it soon, maybe at 5:10. Okay, 5:05 I can finish. Okay, so before starting the next part, I would like to tell you uh, how to purchase class from Tutor online. Okay, so you have to go to Web Tutor online website and click on the navigation menu. Okay, so it will have three lines, and then you have to press courses. So if you press courses, you will get category. Under category, you have to press Edexcel, okay, and then you have to press show results. Then you will get all my classes: Edexcel A2 level accounting, individual, group class, business studies A2 level, business studies A2 level, individual and group class. Okay, even for AS level, you have classes. So you have to press the class that you want, and you have to purchase class. Okay, so if you want to purchase that class, you have to press that. And then before you purchase, you must create an account in WebTutor. Okay, so that you can see what you purchased. Okay, so if you want to do classes, you can do what I said. Okay, um, now let me continue. Okay, so discounted methods. So I told you non-discounted methods payback period and ARR. Now discounted methods, which is net present value and internal rate of return. Okay. So don't worry, I'll try to finish before 5 o'clock since you have class at 5. Okay, Farooz Seema. And then net present value. So net present value is a method of capital investment appraisal that considers the time value of money. Okay, so value of money is the concept that money received in the future does not have the same value as the same amount paid today. Okay, so for example, okay, in simple words, the time value of money is the idea that a sum of money is worth more today than the same amount in the future due to its earning potential. Okay, because of investment, because of interest, because of inflation. Okay, for example, a dollar is worth more today than it will be worth in the future, because money you have now can be invested for a financial return, and the impact of inflation will reduce the future value of the same amount. Did you understand that? Yes or no? Okay. So now, yeah, okay. So now I'll do the NPV calculation. Okay, before teaching you the advantages and disadvantages. So net present value is very easy. So in the question, they will give you, okay, so sometimes in a 55 marks question, they will tell you to find the net cash flow. So in that case, you have to find the net cash flow also. So they'll give a problem sum. Year one, this is the transaction, or this is what happened. Year two, this is what happened. Year three, this is what happened. So you have to nicely understand and find the net cash flow. So in the next week, I will teach you that past paper question. Okay, next Wednesday. So net cash flow year. Okay, so for example, I'll take some values and I'll tell you how to do NPV. So here you draw columns, then it will be easy. First column is year, second column is net cash flow. Third column is 20% discount factor. Okay, so in the exam, they will give 20% discount factor, if not 10%. So you don't need to worry about that. 20% discount factor. And then you have to find the present value. I'll write it here because there's no space. Present value. So here again, you have to put 0, 1, 2, 3, 4, and 5. And under net cash flow, okay. So under net cash flow, year 0, you have to write the cost of the project. Always, you have to always remember that. So cost of the project under year 0, let's say for this example, it's 600,000. And then year 1, net cash flow is 10,000. Okay. Year 2, it's 197,500. And year 3, it's 147,500. And year 4, let's say 380,000. And year 5 also 380,000. Okay. So what you need, so before explaining you this fully, what you need to know under NPV is that you can add saleable value under NPV calculation. So when calculating the net cash flow, if in a question, if they have given saleable value, then you have to definitely add that. Then only your answer will be correct. So let's say year 5, the saleable value, or you can call it disposable value. So disposable value is 100,000. So actually year 5, the value was 280,000. So I have added the saleable value, which is 100,000. So then only I have got 380,000. So it's like that. So remember that point. You have to add saleable value in NPV, okay, under net cash flow calculation. And another point that you need to remember under NPV is that when calculating NPV, you must not take depreciation. Remember that. Okay, you must not take depreciation. So in a question, if they have included depreciation, then you have to minus it. If they included, minus it, because you have to cancel that. Okay, you have to minus. That means you have to subtract. You have to subtract depreciation if they have given depreciation, if they have included depreciation in the question. Okay, but in some questions they will tell, so to confuse you, they will tell running cost of 100,000 excluding depreciation. So if they say excluding depreciation, then you should just ignore that. You must not do anything for that. You have to just take the running cost value, because you don't take depreciation under NPV calculation. Did you understand that part? Yes or no? Okay. So even IRR, even internal rate of return, you must not take depreciation. Okay. So these are the little things that you need to remember when you're doing your exam. So now, when I told you 20% discount factor, right? So in the question itself, they will give you year 1, the discount factor is 1. Sorry, year 0, discount factor is 1. Okay. And year 1, discount factor is 0.833. So they will give in they'll give decimal answers only. Okay. And year 2, the discount factor is 0.694. Year 3, the discount factor is 0.579. And year 4, discount factor is 0.482. And year 5, the discount factor is 0.402. Now it's very easy. What you need to do is to find the present value. PV means present value. Okay. NCV means net cash flow. So under net present value, it's very difficult to find only the net cash flow. To find present value, it's easy because what you need to do is you have to just multiply net cash flow and present value. Okay. Zero. Okay. So minus 600,000 into 1 is minus 600,000. So under 0, you have to put minus 600,000 under present value. Okay. Now you have to calculate this. 10,000 into 0.833. That will give you 8,330 for year 1. And then year 2, 197,500 into 0.694, which is 137,065. And then year 3, 147,500 into 0.579, which is 85,402.5. You have to take that decimal answer also. Okay, so 85. So year 4, 380,000 into 0.482. That is 183,160. Now year 5, that is 380,000 into 0.402, which is 152,760. Now you have to do another step. You have to add all these. You have to add all these and you have to subtract 600,000 and that will be a final net present value. So 8,330 plus this, and then minus 600,000. That will give you minus 33,282.5. 282.5. Okay, so the net present value is a negative value. So this is the net present value. So you can tell therefore net present value is minus, you have to show it in brackets, is 33,282.5. So I'll give you an exam hint. If the net present value is negative, then they should not proceed forward with the project. But if the net present value is positive, then the company should proceed forward with the project. So you have to remember this when you are net present value. Yes or no? Rose Seema, did you understand net present value? Yes, okay. Now advantages and disadvantages of net present value. First one is it advantages. First one, it considers the time value of money. Like I told you before, recognizing that £1 received in the future has less value than £1 at the present time. Okay. Second one, all cash flows used in the calculation of NPV. So when you are calculating NPV, all the cash flow is used. Okay, that is an advantage. And next, considers the timings of the cash inflow and outflows with greater importance being placed on early net cash flows. So it considers the timing of the cash inflow and outflow. Disadvantages. So I'll just explain this roughly because you have to just remember this, not too deeply. Okay. So disadvantages is that cost of capital used to determine the NPV value may be difficult to set. Okay, it is difficult to set the cost of capital. I told you the discount factor is 20% and they have given all that. So that is cost of capital. Okay. And estimates of cash flow may be wrong. Okay, so we have calculated the net cash flow, right? So those are estimates. Okay, so that can go wrong. And this applies to all methods, especially in later years. And cost of capital may change over the life of the project. So cost of capital can change. So I'll explain you in detail what is meant by cost of capital. So cost of capital means the return from a capital project required to make a project worthwhile. Okay, that is cost of capital. Now let's study internal rate of return. Okay. So internal rate of return shows if you are doing internal rate of return calculation, then you must not take depreciation. Remember that. Okay. So IRR shows the true return on the investment expressed as a percentage. Okay. Now this is expressed as a percentage. Return on the investment expressed as a percentage. And it is the cost of capital when the net present value is equal to 0. Okay, that is internal rate of return. So the definition is here. Okay, you have to study that. And the method for calculating IRR is this. So first one, you have to calculate two discount rates. In the question, they will give discount rate of 20% and discount rate of 10%. So you have to calculate two discount rates, and one that provides a positive net present value and one that gives a negative net present value. So one will give a positive NPV and another one will give negative NPV also. Okay, and you have to apply the results of the you have to apply the results of the calculation to the following formula. So this is the formula. You have to always remember this. But I am not going to teach you right now because I need a question. Then only you will understand this completely. Okay. So next class I will explain with the question. Okay. For now you have to remember IRR equals lower discount rate plus difference between the rates into net present value of lower rate. That comes under numerator. You have to divide that by difference between the NPVs. You have to divide that by that value. You have to find the difference between the NPVs and you have to put that under denominator. And you have to calculate this. That is IRR. So IRR is a bit difficult, but once you are used to past paper question, it will be easy. Okay. So now I'll go advantages of IRR. It considers the time value of money. So NPV also same. So I explained your time value of money, right? So I want to explain it again. And then provides the business with the exact discounted cash flow rate of return that the project is expected to make, allowing comparisons. Okay, so it provides the business with the exact discounted cash flow rate of return. Okay, so we can compare that. The businesses can compare them. Okay, and disadvantages. It is complicated. So this calculation is a bit hard. Okay, it is complicated to use and it will not be easily understood by non-accountants. Okay, non-accountants, it will be hard for them to understand that. And this is a time consuming process. Okay, to do this, it's a time consuming process. And also uh, choosing the discount rates for the cost of capital is a matter of guesswork. Okay, so it's hard also. It's a time consuming and costly process. You can say that also. It is a costly process. Okay. Did you have a slight idea about internal rate of return now, Farosima? Yeah, okay. So now weighted average cost of capital. Okay. Um, So when a company raises finance for expansion, or for a capital project, there are costs associated with these funds. Okay, so when a company is planning to raise finance to expand their business or to invest in a project, then there are some costs associated with these funds. Okay, the project or projects under consideration must be able to make a return. Okay, that is at least equal to the cost. Otherwise, there will be no return for the shareholders. Okay, so it represents the minimum return that is acceptable. Okay, so the weighted average cost of capital is based on the capital structure of the company. It includes the equity finance like ordinary shares, debentures, bank loan, all that. Okay, so in other words, weighted average cost of capital is the average amount of a company pays for its capital from all the funding sources. Okay, that is WACC. And then there's an equation to calculate WACC. Cost of interest and returns divided by total cost of the project into 100. That's all. So this also, it will be easy for you if you do the past paper question. Okay, for now you have to just remember this. Okay. Now profitability index. Okay, so the profitability index is a measure of the acceptability of a capital project. It compares the initial investment of a project with the present value of acceptability of a capital project, and it will compare the initial investment of a project with the present value, with the NPV value. So the formula to calculate profitability index is that net present value, okay, NPV divided by initial investment into 100. Okay, so that's all. And then if the profitability I is more than 0, that is positive, then the project is worth investing in. So the company should invest in the project and it will be worth for them. Okay, it will be a worthwhile project for them. And where two or more projects are being compared, the project with the highest profitability index should be chosen. So when a company is comparing two projects, project A and B, which project has the highest profitability index? Let's say project B has the highest PI, then project B has to be chosen. Okay, that is what they're saying under profitability index. And another thing that I want to tell under WACC is that if the WACC is low, then it is good for the company. Low WACC, good for the company. Okay, low WACC is better. And if the WACC is low, then the risk is also low. So you have to remember that. Now, can you tell me whether you understood WACC and profitability index? Yes or no? Yeah, okay, good. Now only this. So after that, I'll finish the session. Okay. So if you, again, I'm telling you again, if you want to study with me, you can contact WebTutor online. Okay. You can contact their WhatsApp number, or you can go to the website and purchase class. Okay. Now look at this. This is an example. Okay. So Fast Fitness PLC, okay, has conducted web appraisal and following information is available. Okay, so these are the information. Initial investment is contract will operate for 4 years. Payback period is 2 years and 8 months. And NPV is 140,000. And IRR is 19%. Okay, So based on this information, they are telling you to evaluate the investment opportunity and you have to make a recommendation to the directors. So what are they saying here is for the investment. So they have to take the investment because NPV is positive. So if it's positive, it's good. And if the payback period, okay, so they are saying the payback period is relatively short. So if the payback period is short, it is good. Remember that. Okay. And should be acceptable as the contract is for 4 years. So the contract is for 4 years. Sorry, there was an internet issue. Okay. I will continue that. Okay. I am unable to share my screen. Okay, so I'll just explain that. Okay, so IRR. Okay, so I told contract is for 4 years. Okay, but in the information that they have given, they told the payback period is 2 years and 8 months. So which is good, right? So because the payback period is short, therefore it's good. So they have to invest in this project. Okay, and IRR is 19%, which is above the cost of the capital. Okay, because IRR, yeah. Okay, so it is good. And providing this type of service would meet corporate social responsibilities. Okay. So that is also an advantage and it is good to invest in this company. Now against the investment, no calculation of ARR. So therefore, we can't invest in this project. And the contract is only for 4 years, which is a long time. What will happen after the fourth year? Okay, will there be an issue? Will there be a problem? Okay, that is another question. And how accurate are the forecasts behind the numbers provided? So this is an estimate, right? So this is not 100% accurate. Okay, so you can tell overall the project appears to be worthwhile. Therefore, it should be acceptable as the qualitative factors are positive. So did you all understand everything now about project appraisal chapter? That's all you all need to know under project appraisal chapter. Did you understand it completely? Okay. Okay, so let's end the session. I hope you all understood everything. Okay, bye. You're most welcome.